private equity valuation. And this is the largest reading in alternative investments, probably one of the hardest ones, so let's make sure we do it well. Okay, I will, as always, or as I generally do, follow the curriculum. Okay, we'll go over a basic introduction, talk about valuation techniques in private equity, talk about private equity fund structures, how do we evaluate a private equity fund, and then go through a case study. Okay, first let's just get a rough sense of what we mean by private equity, and there are several different definitions. This is straight from the curriculum. Definitions of private equity differ, but in this reading we include the entire asset class of equity investments that are not quoted on the stock markets. So a very general definition, but I think one of the best definitions. So when you buy on the stock market, then you are buying publicly traded companies. So if you take an equity stake in something other than what is publicly traded, we call it private equity. So if you have a stake in your brother's business, that's private equity. If you put money in a private equity fund, which in turn puts money into various businesses, that's private equity. Okay, now in level 1, private equity was one small section in the alternative investments reading. Now, and there we were just doing one segment of private equity, which is called venture capital. Now we need to take a much broader perspective. And you must pay close attention to what I'm going to say now, because I'm setting the context for everything that will come in the future. Let's just understand what we mean by private equity and what are the different perspectives that we need to be aware of. Okay, the way we can think of private equity is the following. Let's say that in the middle we have something called a private equity firm. Just as general knowledge, some of the largest private equity firms in the world today are companies such as Blackstone, KKR, Carlyle Group. So that's just general knowledge. In our region, one of the largest private equity firms is a company called Abraj, based in Dubai, run by actually a Pakistani and full of Pakistanis. It's been extremely successful, and most of its investments are not in Pakistan, just in Asia. So in Asia, it's one of the larger private equity firms. Okay, so now, what does a private equity firm do? The way you can think of this is as follows. They are investors like, say, you and me. We do not know enough about private equity investing, but we believe, for example, that private equity investing will give us a good return. So investors, be they individual investors or institutional investors, give money to a private equity firm. A private equity firm will have several funds, private equity funds. So let's say that this private equity firm has fund 1, and the company will define that for this fund, what sort of investments will it make. So various investors give money to the private equity firm, let's say a given fund, and then from this fund, investments are made in various private companies. Okay, so the point being the following. The private equity firm has expertise in figuring out which companies to invest in, and these are private companies. So investors like us give money to the private equity firm, which in turn invests in these companies. Okay, I'm going to read the statement and then come back to this picture. One distinctive characteristic of private equity investment is a buy to sell orientation. Private equity fund investors typically expect their money returned with a handsome profit within 10 years of committing their funds. The economic incentives of the funds are aligned with this goal, as is explained throughout this reading. In the next section, we discuss this buy to sell approach and how funds are typically organized. Okay, so the point being this, that these investors who are putting money in the fund typically have the orientation that with this money, we will invest in various companies, and then within a few years, we will sell these companies at a huge profit. So for example, when we invest in this company, let's say the value of the company is 5 million. we are hoping that 5 years later, this company will be worth, say, 25 million. So we will then get our money back at a handsome gain. Okay, so that's the big picture. Now, some terminology that will keep coming up, so I will set the context right now. The people who run the private equity firm, these people are generally referred to as GPs or general partners. Okay, so general partners put some of their money into the fund, and these are the people who are managing the fund. Okay, now the investors who put their money in are generally referred to as LPs or limited partners. So, and I'll explain this in more detail later, but just now think of LPs like sleeping partners. So they put their money in, let the general partner manage, and then obviously once the companies that the GP invests in do well, the returns come back to the GP as well as the investors. Collectively, you can think of the LP and the GP as the investors. Okay, then in the company, you have entrepreneurs or people running this company. They are referred to as management. So when we talk about company management, we are talking about the people or the managers who are running these companies. Okay, so keep this in mind, the terminology. LP is the sleeping partner, okay, who just gives money and then hopes to make a big return. The GP is the entity or the people who put their own money, but they also do management. So looking at this picture, what do you think the two key roles of the GP are? One key role is raising money, and the other key role is to manage the funds, figure out which companies to invest in, maybe help these companies grow and so on. So the key player in here is really the GP. And what's the job of the management? So they want to make sure that each of their companies does well, and typically the management will have an equity stake in their particular company. So a key point here is to try and align the incentives of the LP, GP and management. Okay, so this is the big picture. Now another angle that I'll share on the next slide, but just set the context right now. The sort of within private equity, very broadly speaking, we have buyout firms and venture capital firms. In level 1, we focused on venture capital. This distinction comes from the category of companies where the investment is made. So if F1 is a buyout fund, what this means is that the money being invested is being invested in stable, established companies. And what we are hoping to do is take a stake in those established companies and then increase the value of that company and then sell that company at a higher value and make a profit. Let's say Fund 2 is a venture capital fund. In a venture capital fund, this is what you studied in level 1. The money is invested in startups. The hope being that we will put money into a startup, make that startup do really well, and then sell it off at a huge profit. Okay, so that's the big picture. Now let's get into some details. Okay, this is taking off from where I just left off. Exhibit 1 tells us about the major categories of private equity firms, and as mentioned earlier, the two major categories that you need to be aware of are VC and buyout. Does this look familiar from level 1? So in level 1, what we are talking about here is these subcategories. Venture capital money could go either into a seed stage where your startup company is just about starting, so you are financing is provided to research business ideas, develop prototype products, conduct market research and so on. So do you remember this from level 1? So don't need to get too hung up with this. I don't think the probability of being tested on this is low because you've already been tested on this in level 1. Key point is to understand what a VC fund is. VC fund is a fund where the money is being used to fund startup companies, and obviously with a startup company there are various phases at which you could do the funding. Okay, now in level 2 we also need to understand what a buyout means. Okay, and all these terms are given, but the ones that are most important, obviously I want you to read this, but I'll just highlight the two most important types of buyouts. One is a leveraged buyout, which is also called a LBO, and this is what companies like Abraj do. What they do is, let's say there is a poor performing company called KESC, all right. Okay, so what the venture fund will do is it will borrow a ton of money at a relatively low cost, put in a little bit of its equity, and buy out this whole company. Then it will try and improve the operations of this company over a number of years. And during the years, from the cash that is generated, it will pay off the debt. And at the end of, say, 10 years, sell off this company at a very high price after having fixed it. Okay, that's the theory. Doesn't always work, but that is the theory. So what has the company done? It has bought out. Why is it called a leveraged buyout? Leveraged means they've taken a lot of debt. So they buy out the company and then eventually increase the value and sell it at a handsome gain. So that's a leveraged buyout. Another scenario sometimes is a management buyout. In a management buyout, what happens is that the managers buy the company. So the managers might borrow money, and the managers might buy the company from the owners. Okay, and then obviously the incentive of the managers is to improve the company, and from the cash flow they pay off the debt that they have taken, and eventually obviously they can have the company with very little debt. So those are the key terms. We will see this in more detail later. Okay, the next segment talks about introduction to valuation techniques in private equity. Now there is a big link between what you see here and one of the readings in equity, which is on private company valuation. Okay, so you will see a lot of parallels. All this should look familiar, so I won't spend too much time on them. Is it a surprise that we use some sort of a discounted cash flow approach to value this? Should not be. Okay, so value is obtained by discounting the expected future cash flows. This is generally applied. Okay, given the emphasis on expected cash flow, this methodology provides the most relevant results when applied to companies with a sufficient operating history. So the core point is, obviously, if you are forecasting cash flows, it's very hard to do so for a startup, but for an established company, it's easier. Okay, relative value multiples. So all the material that you saw in private company valuation is relevant here. Typically, one of the most commonly used multiples is value to EBITDA. Okay, so I want you to read this exhibit. There is nothing here that should surprise you. Okay, just as a side remark, real options, we talked about these briefly in corporate finance. So when there is lots of uncertainty involved and there are lots of different options that are involved, you can use real option valuation. In this reading, you don't really need to know what real options mean. You just need to know that it's one of the techniques that is occasionally used. And replacement cost, this actually is quite useful. Replacement cost, if you have a small company that's been around for 1 year, where most of the value is coming from what might happen in the future, one way of valuing a company is to say, how much will it cost me to start from scratch and build a company and get it to the same stage? Okay, so that's called a replacement cost approach. Okay, now section 2.1 talks about how is value created in private equity. So where does the value come from? And this is this is simply one of the learning objectives also in this reading. So the core points to know: one way of creating value is to re-engineer the firm and make it more efficient. So why has Abraj done so well? They have done well because in general they have done a great job of buying out poorly performing companies and then making them a whole lot more efficient and selling them at a much higher valuation relative to what they initially bought the company for. Okay, how and why does that happen? So good private equity firms have the management who can go into a firm and help improve it. Okay, and when a firm improves from the same assets, if you are producing a lot more cash flow, what happens to the value of the firm? Value of the firm goes up. Okay, so that's one method. Another point is that let's say that you are at this company one, that's not performing very well, but you are a manager here and you believe that by raising debt, by borrowing money, you can then use that borrowed money to make some investments and improve this company. But if the company is not performing well, will it be easy and low cost for you to raise money, or will it be very costly to raise money? It will be very costly to raise money. On the other hand, if a private equity firm with a track record of taking over companies and turning them around, if this company tries to raise money, their cost will be much lower. Right? So the point here is that this private equity firm can create value by borrowing money at a much better rate, and then using that borrowed money to turn around companies that are not performing very well. So the ability to obtain low-cost financing is another big reason why private equity firms create value. A third point is that in general, private equity firms do a good job of aligning the goals of management and private equity owners. Private equity owners here collectively refers to all the investors. Remember the limited partners and general partners? At this point, we are just bundling them together, and effectively these are the entities that are providing the capital. So they are the providers of capital. So the point here is to minimize any agency costs, a term that should sound familiar, by aligning the goals of the limited partner and the manager, or aligning the goals of all the investors or the private equity owners and the managers. How do you think this generally happens? Yeah, generally this would happen by, by giving management a decent equity stake. So managers, and this happens a lot, especially in VC companies, VC funded companies, where management owns a significant chunk of the company. So there is all the incentive in the world for them to work extremely hard and increase the value of this company. Okay. Managers in this context will often have a longer term focus or a long-term focus. Why is this an advantage, and how is this different from public companies? In a publicly traded company, does management have an incentive to maximize earnings in the short run? Very often they do, because a lot of bonuses are based on short-term goals, and sometimes management might just be there for a short time. So their immediate goal would be to maximize the earnings and revenue this year, but possibly at the expense of what happens in the future. In private equity, since you don't have stocks traded on the stock exchange, that short-term focus will probably not be there, and instead there'll be a longer-term focus, which is better for value creation. And finally, what happens in private equity firms is generally there is an effective structuring of investment terms. These are the terms, or effectively the governing, the very loose comparison would be in the corporate publicly traded company world. The corporate governance charter defines the balance between investors and company management. The roughly analogous term in the world of private equity is a term sheet. So we want a term sheet that results in a balance of rights and obligations between the private equity firm and the management team. And this is an excerpt from the curriculum. What are the sorts of things that the term sheet, or this, for lack of a better term, the corporate governance charter might have? This, as a side remark, generally when things are bulleted in the curriculum, my feeling is that those things are generally important. So I would have you read these, but I'll summarize them for you very briefly. So generally, as you might expect, the private equity firm will be on the board of all the companies that they've invested in. So this ensures that private equity control in case of any major corporate events such as company sales, takeover, restructuring. So for example, when Abraj takes over a company, Abraj people are on the board of that company to help ensure that the company is making the right decisions. Typically, there'll be things like a non-compete clause. So this is imposed on founders. So if a private equity firm invests in company one, there will be non-compete clauses where the senior most people, such as the CEO of C1, can't just jump off and start another competing company. Okay, so there are clauses that ensure that key people stay at the company. Okay, anyway, that should give you a flavor for what is over here, but the key point is to set up terms such that the incentives of the private equity firm and the company management are aligned. Okay, now here again, using market data in valuation, this is material straight out of private company valuation that you saw in equity. I'll read this and it should look very familiar. The two most important ways in which market data are used to infer the value of an entity being acquired are by analyzing comparison companies that are quoted on public markets. Okay, so comparing, the guideline public company method, hopefully that sounds familiar, and valuation implied by recent transactions involving similar entities. Okay, so this is bang out of what you studied. And this should be no surprise because effectively what we are doing here is valuing private companies. The multiple that is used most often is your EBITDA related multiple, so enterprise value to EBITDA. Okay. Another important learning objective is covered in section 2.3, and this talks about contrasting valuation in venture capital and buyout settings. Okay, so you need to read this, but I will just help you memorize the core points. Realistically, it's impossible to remember every detail, but at the very least, for all the important points, you need to have a sense for what's contained. So just logically speaking, when we do valuation and buyout versus VC, what are the core differences? With a buyout investment, typically you are investing in a somewhat established company. So is it reasonable that you will have steady and predictable cash flows relative to a VC where you are investing in a startup? So there is very low predictability about the cash flow. So here there is low predictability. Here there is generally high predictability. Your projections may not be realistic here. Here it's easier to make projections. Excellent market position. If you invest in a buyout company, very often the market position will be good. Okay, so the core point is here you are going after established companies, so generally it is easier to predict, whereas in the VC environment, unpredictability is high, risk is high, and so on. Okay, so with that in mind, as you read through buyout investment characteristics on the left versus VC investments, the difference should be obvious. On an exam, you might not remember this, but if you remember the core difference between buyout and VC, then any guess that you make will hopefully be correct. Okay. Anyway, so just I'll pick on an example here. What did we have on the left? Buyout or VC? So this was VC. So does it make sense that in a buyout, since you are working with an established firm, there'll be generally low working capital requirements versus if you are working with a startup? Okay, as the startup becomes larger, the capital requirements will expand. So all these are fairly obvious comments. Okay, the list goes on. I want you to just read it once. Don't memorize this, just recognize what this is about. Okay, now we get into some more exciting stuff. So valuation issues in buyout transactions. The question is, where is the value coming from? I'll give you a context here and then we'll go through some numbers. Let's say that you are a private equity firm and you have invested 10 million. Okay, so you invest 10 million in a bunch of companies. Okay, so let's say that you make 3 investments worth 3 million, 3 million, and 4 million. Okay, what you are hoping for is, typically the life of a buyout fund is about 10 years. So what are you hoping for over the 10 years? You are hoping that the investments that you made increase in value and then you sell them at, you made a 10 million investment, let's say after 10 years you sell them all for 80 million. Okay, now where does that increase in value come from? Let's say you are starting with your base of 10 million. One is if you can make them more efficient, and or you can grow the company. So if there is earnings growth, what will that do to value? That will increase the value. Okay, multiple expansion. Now, where does multiple expansion come from? What is this saying? This is saying that when you bought the company, let's say the price to earnings ratio was 7. Multiple expansion means that now the PE ratio has, say, gone up to 12. Why might you increase the PE ratio? A, if the growth rate has increased. B, the efficiency of the company has been improved, your turnover ratios and so on are better. So if these two things happen, what will happen to the PE ratio? The PE ratio obviously goes up. So first value creation was simply by core increase in earnings. So even with the same PE ratio, the price will go up if your earnings are up. The second, if you improve your multiple, that also increases value. And third, debt reduction. Okay, so how will debt reduction increase value, Taqir? Yeah, so as a company is paying off its debt, okay, obviously then the value of equity goes up. Okay, so what most of these companies do is initially take on a lot of debt, but then with the steady cash flows, they keep paying off debt. So let's say if initially debt represented 50% of your capital structure, that means only the other 50% was equity. If over time that's brought down to 10%, then obviously reduction in debt with even the same assets means that equity has increased. Okay, so just keep in mind the bottom line from this slide is that value is created by increasing earnings, by increasing multiples, and by paying off debt. Okay, so when you exit, then the goal is to be a whole lot richer. Okay, the second large point here, which will then be elaborated on the next slide, is that the structuring of LBO. What does LBO stand for? So this is your leveraged buyout. So these transactions involve a negotiation between providers of equity capital, senior debt, high yield bond, etc. The point here is the 10 million. Where is the 10 million coming from? Just like when a company is funded, what are the sources of funds? It could be either equity investments or debt-based investments. Within debt, there are different levels of seniority with debt. There can be the completely safe senior debt, which means that in terms of any assets being liquidated, the first people who will receive money are the senior most debt holders. So similarly, in a leveraged buyout structure, there will be some people who are providing equity capital, which means they are taking the most risk and hopefully getting the most return. And then on the debt side, there will be different levels of debt. There will be people who are providing money but under the safest conditions, that they will get their money back first. So their return is likely to be the lowest. Now let's just to get deeper, understand this through an example in the curriculum. Now this is going to combine the points I've just been talking about, and it's based on Exhibit 5 in the curriculum. All right, so we have an equity investment of 5 million. Just as a quick terminology, this M in this example stands for 1,000. So that's 5,000, 1,000. So that's a 5 million investment. And this is 50% debt and 50% equity. Okay, then the equity is further broken down into, so 50% of 5 million is 2.5 million or 2,500 M. M stands for 1,000. So 2,400 is preferred shares owned by the private equity fund. 95, so we are saying that of those 2,500, 2,400 is preferred shares. Of the remaining 100, 95 is equity owned by the private equity fund, and 5 is equity owned by management. What do we mean by management here? Yeah, management of the company. Okay, this is aligning the incentives of the company with the private equity fund. In the private equity fund, are we talking about the limited partner or general partner? We are talking about both. So here we are in general talking about them collectively. Okay, so 5% owned by management. So that is all depicted in this picture over here. Initially, how much are we investing? 5,000, of which debt is 2,500, preferred shares 2,400, and private equity is equity is 95, and the management equity is 5. So everybody gets this? Okay, now let's say that from 2008 to 2013, what happens is that this fund grows by 1.6 times. So from 5,000 we go up to 8,000 in these years. So from 2008 to 2013, that's the growth that happens. Okay, now the question is, this pie has become larger. It's gone from 5,000 to 8,000. Now who gets what? Okay, who do we need to pay off first? Debt holders. The way debt works is, as the company is generating cash over these years, the debt holders are being paid off. Okay, so we aren't asked to do the calculation here. We are just given in this question that over these years, the debt is now down to 1,600. This means that the rest of the pie belongs to the various kinds of equity holders. We are also told, remember, preferred shares or preference shares are this intermediate category between debt and equity. So once the debt has been paid off, the next people who get their money are the preferred shareholders. We are told that the preferred shareholders get 12% rolled up dividend. What does this mean? This means that the preferred shareholders are getting paid at a 12% rate. Rolled up means that all this 12% is rolled up and given to them at the end. Okay, so how do you figure out if the preference shareholders, how much money did they put in? 2,400. If they are getting a 12% return all rolled up and at the end, how do you think you got this number of 2380? Yeah, exactly. It would be 2,400 into 1.12 to the power a number of years, which is 5. So that will give you this number. Okay, now obviously our overall pie here is large enough to also pay off the preferred or preference shares, so they get this money. Now what about the rest of the pie? How much is left? How do you figure out this amount? It's the 8,000 minus 4,230 minus the remaining debt, which is 1,600. So who gets this remainder amount? The residual interest is for the equity holders. So 95% of that residual interest goes to the private equity fund and 5% goes to the management. Okay, so look at how well the management did. How much money did management put in initially? Yeah, so their 5 million became how much? 109 million. So that's why some founders of startup companies tend to do really, really well. Okay, these are the guys who worked the hardest. So anyway, so their 5 million became 109 million. For the private equity firm, the 95 became 2061. Okay, and so on. So you can see how this works. You have regular debt, preference shares, which comes after that, and then the residual income or the equity part. That's the one that can do really well if the company does well. Had this company value not grown that much, had it only grown up to here, then what would have happened? The debt would have still been paid off. Most of the preference shares would have gotten their return, maybe not the full 12%, but the equity guys would have gotten nothing. And if there is anything more than that, all of that would go to equity. So that's why this is same concept as what you've seen before. Okay, just to some extent it is highlighted over here.